What's up everyone, it's Scotty with MoneyVest. So in this video, I wanted to go over my entire playbook when it comes to how I approach the markets when it comes to investing and trading. So everyone's style of market participation is going to be different. Some people simply day trade, some people swing trade, some people are simply investing for the long term. So in this video, I want to break that down in a lot of detail, and it's going to clear up all the confusion there is to how I approach the markets when it comes to investing and trading. Because a lot of the times when I'm doing a lot of these market updates, I've seen some comments that are still not clear as to what specifically I'm talking about when it comes to our market analysis, when we're talking about these technical terms, overbought, oversold, like what does that really mean and what's the call to action from that analysis. So this video is going to clear all that up, and going into 2024, hopefully it's going to be another banger year. This was a fantastic year in 2023. We've had some very, very good gains and growth and returns. So thank you so much for being a part of our amazing community. If you want to join and learn more, link's going to be down below. This is going to be a bit more educational and more sort of like clarification type video, if you will. So again, hope you enjoy it, find it helpful. Please share this video with somebody you think might benefit from the information presented here. And links to our Discord and Patreon is going to be down below. All I'm asking is that you subscribe and of course join our Discord if you are interested. There is a 16% annual discount available until the end of this month. By the way, I am re-recording this video because I recorded for the first 12 minutes and realized that my audio was not on. So that was frustrating. Okay. Now, when we're talking about oversold versus overbought, right? These are technical terms that we talk about in the markets, and that simply means, if the market's been rallying pretty aggressively and it's gotten to a point where, it's overbought, that simply is a technical term that we're looking at. Same thing is true when the markets are oversold, meaning that they've been selling off quite aggressively. They've just been dropping pretty hard, and now they are oversold. So when it comes to my strategy, okay, at any given time in the market, at any given time during the year, I'm at least 70% invested, okay? At least 70%, meaning that's the minimum that I would at least be invested in the market on the long side, meaning I'm long invested at least 70% in the markets. And my cash fluctuates between 4 and 30%. 30%, if my cash is at 30%, that means I'm invested 70% in the markets, and that would happen when, let's say, the markets have been rallying too hard, they're overbought, they're expensive, there's not a lot of deals out there, I can't find any opportunities, and I'm raising more capital, I'm de-risking from the markets a little bit because of how expensive I think the stocks are or how overvalued the markets might be. 4%, as you can imagine, if my cash level is at 4% and I am 96% invested, that simply means that I am very bullish on the markets, right? I'm seeing a lot of deals out there, and that happens when markets are oversold. They're cheap. I'm seeing a lot of deals, a lot of opportunities in the market, and I'm aggressively dollar cost averaging and deploying cash into the market. So my cash fluctuates between 4 and 30%, and I'm at least 70% invested in the markets. Now, when it comes to trading versus investing, there's no sort of rule of thumb that you have to do one or the other. It depends on your personal preference, curiosity, and your skill level, okay? For me, for example, like I am mostly invested for the long term. And when I say long term, we're talking at least 1 year plus, okay? 1 year and over is considered long term. Anything less than 1 year is trading, okay? It's short term. So for me, the way I've structured is I'm mostly invested long term. I would say like 60 to 70% I'm invested long term, and the rest is focused on short-term trading, which is swing trading, day trading, even scalping sometimes, and then options trading, okay? That's where I'm focused on, and that's where the analysis for risk and reward comes in. I'll go over that in more detail, but if your time horizon is long-term, 1 year out, and we're talking 5 years, 10 years, 15 years, 20 years, in fact, I'll share a chart later in the video that's gonna clear everything up. It's going to literally just open your mind, and it's going to tell you exactly that if you are investing long-term, 15 years plus, if your time horizon is 15 years plus, 20 years plus, it literally does not matter what prices you pay for stocks on a broader basis, on an ETF basis, S&P 500 basis. There's a very high probability that you're going to make money. There's a very small, probably near zero probability, 0% probability that you're going to lose money if you're investing long-term and simply dollar cost averaging, okay? I'll go over that chart later in the video. So here's the difference. When we are doing our analysis and I'm going over, overbought and oversold and volatility, I'll go over the indicators, what I look for and, what I share. It is simply coming from a short-term risk-reward perspective. That is it. That is literally it. And when it comes to investing long-term, there are very specific fundamental indicators that I look for, but over the long term, it does not matter. It does not matter. You can literally just ignore all the noise and simply focus on your long-term investing and dollar cost average, regardless of what's going on, because it's proven. It has been proven to have performed, and there's a very solid track record with that, which I'll go over later in the video in that chart. So when it comes to our technical indicators and what I look for, simply for the purposes of trading short term, again, trading meaning we're actively trading, we're looking for opportunities, looking for deals, analyzing the risk and reward, and short term meaning less than 1 year. We're talking about the RSI, the MACD, the market breadth, right? Which means what percentage of stocks are trading above, below their moving averages. How are the Magnificent Seven stocks doing? How well are they performing? Support and resistance levels for S&P, NASDAQ, very specific critical areas. Market streaks, how many days or weeks the markets have been rallying or selling off. Magnificent Seven concentration, so how concentrated this rally is among the big tech, or how broad-based participation are we seeing. Volatility, of course, a very important indicator, which is the VIX. Is it higher, lower? How, when was the last time it spiked? When is the next time it could spike? Yields and dollar, what's the overall trend? Because all of that affects the overall technicals for the market. So this, when we're going over this in our market updates, it is simply coming from the perspective of trading and analyzing the risk and reward, okay? And the call to action is, again, analyzing the risk and reward so we can look for opportunities both on the long and the short side, considering everything that I just mentioned, okay? So to give you a simple example, RSI MACD right now for the market, overbought. Market breadth, very, very concentrated. 90% of stocks are trading above their moving averages, so this has been a very nice momentum higher. Markets are approaching their resistance levels, they're approaching their all-time highs. This has been 8 consistent weeks of green, so very strong streak of greenery here, and Magnificent Seven concentration has increased to almost an all-time high at over 30%. Volatility is really, really low, at a 2-year low right now. So what does that tell us? That simply tells us that risk reward right now on the long side is unfavorable. It's only from a trading perspective. That's it. That's it. Nothing else. Literally, the only analysis that we can take away from this is that the risk and reward on the long side, trading on the long side, is unfavorable. The reward is not worth the marginal downside, the significant downside it carries. And for those reasons, I'm not taking any trades on the long side. That's it. But when it comes to investing, if I have a time horizon of 5 years, 10 years, 20 plus years, none of this matters. None of this really matters, okay? All that matters is understanding, of course, what you're buying, right? So finding good quality companies and buying them at good prices. And market valuation is part of it. Economic forecast is part of it. Interest rate projections are part of it. Recession expectations are part of it. But even then, for the most part, you can kind of ignore those things and still come out on top if you are invested long-term. We're looking 15, 20 years out, okay? The shorter the time frame, the more the analysis with risk reward. The longer the time frame, the more simplistic the analysis can be. And this right here is what's going to clear up all the confusion and everything that might be sort of worth mentioning. So what we have here is the odds of losing money versus the odds of making money in the markets. And that is going to be it's going back as far as 1920. So 1920s all the way through 2022 for the S&P 500. And what you'll notice is time horizon over here. And if it's 1 month or 1 year, so that's short term, right? Anything less than 1 year is short term, as I mentioned earlier. Look at the probability of losing money, 38%. 38%, it's a really high probability, and 62% probability that you make money. 25% in 1 year that you lose money, and 75% that you make money. So when we're doing our analysis for risk and reward, when we're going over our technical indicators like volatility, market breadth, RSI, MACD, overbought, oversold conditions, support, resistance, all that is simply for the purposes of understanding how good the risk reward is within 1 year. That's it, within 1 year. This is literally our entire analysis when we're doing our market updates. This is the time horizon within which we're operating when we're looking at technicals. But when we're looking at fundamentals, look at this. 10 years and plus, the probability of making money is over 95%, almost 100% probability that you invest it for the long term, 10 years and more. The probability that you're going to make money is incredibly, incredibly high. The probability that you lose money is really low, 5%, less than 1% probability that you lose money if you're invested for 15 years plus. So long-term investing here, long-term, none of the other technical noise and none of the other market forecasts and projections and predictions matter. None of that matters if you're invested long-term, 10 to 15 years out, 20 years out, 30 years out, because the probability is right there. It's literally statistics going back several decades. And it's right there. The probability is making money is very, very high if you're invested long term. So hopefully this kind of clears up some of the confusion, some of the things when we are assessing the risk reward. We're strictly doing it from the purposes of trading opportunities, right? So we're looking at over here and the time horizon less than 1 year, so short term. But long term, when it comes to investing, which does need to have a long-term horizon, long-term time horizon, 10 to 15 years out, really doesn't matter. Dollar cost averaging into broad-based ETFs or index funds or even very high-quality companies at great prices, and just simply holding and dollar cost averaging. And of course, you got to recheck your story every so often, every quarter when the company reports earnings. But 10 to 15 years out, when it comes to S&P 500, it has been proven to perform really, really well. So I hope you guys enjoyed this video and found it helpful, and you got a little bit of a clarification on how I approach markets and investing and trading. A significant portion of my portfolio is simply focused on long-term investing, and of course a small part of the portfolio is focused on assessing the risk reward, trading short-term, looking at swing trading, day trading opportunities, options trading, and of course assessing the risk reward, because short-term there's more fluctuation in the market, there's more fluctuation, there's more volatility here, and long-term it's simply over here. You've seen that chart, right, where it shows like short-term, 1 month, 1 year, there is a lot of volatility. There's a lot of volatility in the market short term. But long term, the markets are just like this, right? They're just moving higher. And that's exactly what we're doing in our analysis of risk and reward. The risk reward and overbought, oversold conditions focuses on here. Long term, great companies at great prices and great ETFs focuses on here. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Again, link to our Discord and Patreon is going to be down below. Don't forget, we do have that Christmas sale right now, 60 to 70% off, coupon code Santa Rally. Link's going to be down below. As always, happy investing. I'll see you all in the next video.